Thank you very much for asking me to join the panel. I must say I'm learning a lot and very eager to interact further. Hopefully we have time for questions at the end too. So I want to address the call, how financial infrastructure can affect inclusion and inequality, mentioning both physical and digital infrastructure, and come to the policy and regulatory actions that have already been mentioned by the previous panelists. So specifically, how does financial infrastructure affect inclusion and impact inequality? What is the evidence pre-COVID? So I'm gonna take that literally and tell you just very quickly some research. So this is going to be pre-COVID, it's historical, and it's going to focus on physical infrastructure, which Camille mentioned banks. And so this is an expansion of banks in a particular setting. In particular, this paper with Yanji Teng and myself, we are fortunate in Thailand to have data on the opening of new branches between 1986 and 2011, almost 1,500 branches, from which we define local financial markets. I want to share with you some lessons from the data and the model, and particular focus on identifying the dynamics of this expansion, the transition paths, delays, uneven effects across local markets, and indeed seemingly perverse impact. I don't want to share these with the goal of casting a discouraging note. On the contrary, I'm a big fan, as you will see, of the new technology and efforts to reduce poverty and lessen inequality. But I want to share this because we do not want policymakers to be blindsided to the short-run impacts of the policies. And they're going to have to build a commitment against political pressure as these dynamic systems evolve. It's good in the end, but it takes quite a number of years to get there. So if you look, for example, at the impact of the branch expansion, lots of good things happened, as you might have anticipated. It's associated with a growth of GDP, quite a bit actually. Almost all of it, the model does pretty well against the data, and this growth is attributed to growth in labor as farmers leave and go to a more productive sector, growth in capital as households accumulate wealth and invest, either in their own business or in banks through intermediation. And the model does significantly raise access and lower variation in inequality in credit access. So all those things look great. Now there is an intermediate result, but I think you're familiar with it, which is the Kuznets curve. So the model generates a hump-shaped income Gini. And the warning here is that inequality initially increases, but then it decreases. And the model, by the way, matches the data. So presumably something like this was going on. So as you open branches for the unbanked population, it allows a relatively small number of talented entrepreneurs to access credit that they had not had before and earn more income. So that's the part of the increase in inequality. So Gini is going to deteriorate in some sense, be higher in earlier years. Eventually, there's an increasing demand for labor to work in those firms and set up new businesses. And this pushes the wage up as initially farmers leave the agricultural sector, but it's not enough. There's a shortage of workers driving that increase in the wage. And so ultimately, Gini falls. So be prepared for these kinds of dynamics, and expect the policies to take a little while to reach wider wider beneficial effects. It's actually a bit worse, although I don't want to dwell on it. If you focused on the average wage in an economy, it actually goes down. The reason being there's a selection effect. As farmers who were previously earning less join the labor force, their wage is lower and it's averaged into the whole, lowering the overall wage. And these pressures that eventually increase wages do not happen uniformly across the country. Eventually, yes, but the takeoff point is different for different points in space. So if you looked across markets, you would see income inequality going up. And there are large welfare gains, as I've been saying, but it takes a while to get there. Okay, so as the previous panelists have been discussing, Luis and Leora, we could think about digital banking and digital payments. As in Brazil, the PIX system that the central bank has been initiating, but also India and other countries that the panelists have mentioned. So through the lens of the Thai model, we kind of do a what if experiment. What if in 1986, Thailand had the digital currency? I know that's, and digital banking, that's of course unrealistic. But the point being, we can now compare what actually happened to Thailand and through the lens of the model relative to this new version where we really don't need physical bank infrastructure anymore. So as anticipated, introducing digital banking does eliminate much of the regional heterogeneity, and it does so really quickly. However, given the other aspects of the model, wealth accumulation, slower transition into business, and so on, there are impacts that take a while to materialize. We can even in this way think about central bank digital currency. Suppose, given the model, we replace all the paper currency in the model with interest-bearing accounts, essentially by making the transactions cost of the branch zero, because you really don't need branches at all for this, since you can do it electronically. This does eliminate currency from the household wealth portfolio, which had been otherwise held for consumption smoothing, and it does increase welfare. However, at the calibrated parameter values, the impact is rather modest. We can compare that to the other electronic aspect, namely digital credit, lowering credit costs to zero in the initial year while letting the branches expand on the savings side, the opposite of the first experiment. So this removes currency by entrepreneurs to self-finance. They don't need to do it that way anymore. And this has a much larger impact. So taken at face value, we could say that if countries were like Thailand, the rise of digital banking, the larger impact will be on the credit side rather than on the savings side, but payment side. But I caution to add that there's actually complementarities. If you take the sum outcome of these two experiments independently and add it up, it is less than the total, because I guess it's intuitive. Through intermediation, the savings side is interacting with the credit side. So we really do need both, but at least we can think about aspects of central bank digital currency through the lens of these structural models, as well as considering the dynamics and so on. I want to say also that, model building, it matters what you put in, and you really have to be careful. It's not like there's one obstacle that fits all heterogeneous populations in all countries. So this work with Felice Ansal, as well as Dabla and Yanchi, we distinguish the constraints on financial inclusion. There's financial access costs, collateral costs, bank markups that have to do with costly verification. All three ingredients are in the model. The question is, which fit best, or which combination fit a given country that's contemplating policy changes? It's actually hard to tell from the data what the most binding constraint is, and you're easily misled by the data to the wrong one. So you do need the structure of the model with the data to figure out what the constraint is and hence what the impact is going to be. If you choose the wrong constraint, focusing on the wrong policy, say lowering collateral constraints in a country where the other constraints are more binding, the policy is going to be less effective and financial inclusion measures will not achieve the goal nearly so efficiently. So the point of this is research is relevant. Least you worry a bit implicitly that this is an academic just promoting research. I do want to reassure you, the goal here is to have a beneficial impact on policy. And this paper in particular, through the IMF, jointly with MIT, was adopted and used by the country desks in various countries to sort through the various strategies they could use to increase financial access and promote growth. Another question that was posed to the panelists, how did financial infrastructure attenuate or exacerbate the impact of COVID on vulnerable households? This is something in the US that Camille addressed, and my points just replicate what she said, that Fed Main Street and paycheck protection programs rely on commercial banks and hence on the relationships they had with their customers. It was really very difficult to target efficiently to key small and medium enterprises, say, that have a pivotal role in supply chains and flow of funds. So we have a problem in relying on legacy information and financial infrastructure. In the US, it is quite limited, and the virus, as Camille said, had the consequence, among many other, of revealing this chronic gap in the information and financial infrastructure. So the question then is what to do, which measures could central banks take to better support vulnerable households, not simply in the recovery, but in longer term through financial infrastructure. So there's a list of 5 things here, and this is an agenda for the US. Contracts, say between a bank or a financial institution, including fintech and an SME, those are the objects traded. We need innovation there to not rely exclusively on relationship lending, but to use the technologies available now through programmed smart contracts to automate things, and using the tools of cryptography to enable the necessary security for strangers to deal with each other, not just for people with previous relationships. Securitization is important, a very needed innovation. Here again, partial information is probably the best way to go, rather than going for a full privacy versus full disclosure. And cryptography allows these combinations to be part of the optimal securitization design. I think database infrastructure is key. The creation of it, the access to it, and the use of it. We need to utilize existing data, organize better across existing data sets. You can see people really being very creative to track the impact of the COVID using this or that data set, but they're not necessarily all consistent with each other. Probably need to create new data as needed, and particular link to electronic transactions so we get more in real time. Data are inherently a public good, as was mentioned earlier, although we do need to respect the privacy aspects and provide incentives for participation. Multi-party computation allows encrypted line items of financial accounts of firms and banks to be aggregated up for analysis while totally preserving privacy. So again, what I'm arguing for here is to take advantage of the new technology to create the needed infrastructure, including the matching of parties and trading of contracts where you don't need to rely necessarily on a big tech or a not so trusted third party. and ensure competition across the platforms. So we need not just to develop the infrastructure, but to have an overall regulatory blueprint, which is not traditional, rather takes advantage itself of the new technology. So thank you very much.